Initially we used to buy plots in Kangundo, plots in
We had this conversation in partnership with Vaal. We talk about why Nairobi is Africa's underrated premium investment gem.
1 out of 10 Nairobians own a home.
1 out of 10.
1 out of 10. There is a huge potential.
We talk about why premium luxury investing isn't only for the rich and the different options that they have of financing. We talk about different ownership models. We talk about the regulatory requirements and the vague nature that they exist in our current ecosystem.
The challenge we have currently with our legal system, we don't have one statute that regulates short-term rentals. It has developed faster than our regulatory framework has developed.
We talk about what an economic bubble is and whether we currently are in a real estate bubble.
In an economic bubble, there's so much access to credit, and we'll agree that accessing credit in Kenya is a problem. The mortgage penetration rate is below 3%. It's very hard to walk into a bank today and get a mortgage, or even just get a loan to buy an asset.
We discuss Vaal's Divine Residence, how it sets itself apart from a premium luxury investment in the real estate space, and how they've positioned themselves to compete with the hotel and tourist market.
We've curated our offerings in a very unique way. This is actually hotel apartments.
An enlightening discussion. If you want to invest in real estate, this is an episode you have to listen to.
Hey guys, this is Barak from Financially Incorrect. I am here to say thank you so much for the 50k plus people who have subscribed to Financially Incorrect. We really do appreciate you. When we crossed 50k, we had a nice small intimate party at our offices and we celebrated this milestone. I have convinced the powers that be that if we can get to 100k by December, we will throw a big party to celebrate with all of you guys. And now we have 3 different segments for you guys to watch. There's Financially Incorrect Business Edition, Financially Incorrect Uganda Edition, and Financially Incorrect the regular Kenyan edition. So please do, if you like our content, subscribe. If we get to 100k by December, we will throw the biggest party in East Africa. So please do subscribe.
Hey guys, this is Barak, the host of the Financially Incorrect podcast. This episode will start a little differently than usual because we shot this in partnership with Vaal, where we're talking about why Nairobi is Africa's underrated property investment gem. So when we get to the episode, we'll go right in. There won't be any. I think there's an introduction for the panelists, the people who are speaking, but we go right in. I don't do my typical intro, and so this is my typical intro for this episode. Enjoy. So just to start, I'd want each of you to just give me a minute response to this on the importance of passive income, just to sort of lay the groundwork of what we're going to talk about today. So from your perspectives, from your professional perspectives, what's the importance of passive income? Why is it important? Do you want to start on that side? Do you want to start here?
I can start. I think one of the most important things about passive income is having something that you can actually leverage on. That's what most people who are looking into property investment are ideally looking for. If you were to ask a majority of us here, and including our leaders, to declare their wealth, that you're going to realize that a majority of them have actually put their wealth into real estate. There's a reason behind that. And the key thing here is basically just leveraging and more leveraging. How do you leverage on real estate to create even more wealth? Yeah.
Okay. So for you, the importance is the ability to leverage. Okay.
I think for me, my understanding is the ability to be able to make money and create wealth that is not dependent on you working, that you do not have to wake up every single morning to go to work for you to make the money. It's basically what we say in very simple terms is making money when you sleep. Whether you are sick, whether you are there even beyond your lifetime, there's still income that is coming from your investment. That for me is my understanding and my definition of passive income here.
For me, I think my response is quite close to what has been shared, and I'd put it as security, especially long term, because when you're employed or when you're running a business, anything can happen any day. And so passive income, especially long term, then offers you security into especially uncertainty that may come in the future. Yeah.
Okay. This question I put to Linda and to Samuel, and I want to contextualize where real estate sits, right? So if we're looking at yield, and I think this is over the last couple of years, short-term rentals would be giving you between, and this again, this is not off of the data that you have. This is purely from research, between 7 to 10%, right? Bonds, government bonds would give you between, I think between 14 to 16% thereabout. Money market funds at the moment are doing between 8 to 11%. Stocks would historically give you between 12 to 18%. So where's the case for short-term rentals? Because if we're looking purely on the rate of return, it's fourth, I think, in line. So what's the case for short-term rentals as the opportunity that one should take for passive income?
I actually appreciate the fact that you actually brought out a comparison factor.
Yeah.
And people would be asking that question: why would I go for real estate when equities are giving me a higher yield or fixed income is giving me a higher yield? I think one of the cases that I'm going to make for real estate is, number one, predictable income, all right, which is usually not the case when you're looking at equities and fixed income, all right. They are greatly affected by how the economy is performing in general. But if you were to compare that to real estate, I know one of the concerning factors would be inflation. One thing you're going to realize is people actually do use real estate to hedge themselves against inflation. So it's more stable, it is more predictable, all right? And then number two, you more or less like killing two birds with one stone, because the property gives you an equity upside, so because it appreciates over time, while at the same time giving you a rental yield, all right? And then number three goes back to the point that I had actually mentioned earlier, that you could leverage on it. Number four, I would also say there's tax benefits and reliefs that come with real estate, especially for people who are considering entering into this space via mortgage. Depreciation as well comes with a relief factor as well. Capital gains comes with a relief factor as well. So that's the case that I would make for real estate if I was to compare it to, again, equities and fixed income.
Okay.
Just to add to what he said, so if you look at equities, the return is higher, but then more volatile than real estate. And again, on the equity side, the share price or the perception of investors, which affects price movement, is also affected by corporate governance. So if today we wake up and we hear a certain company has some issues, drastically you will just see the share price drop from nothing. Whether it was speculation, whether it was true, investors will not really take time to want to know or to get into the in-depth of the story. If you look at dividends from stocks, the return is about 3 to 5%, which is also lower than for rental income. Moving to bonds, most bonds are usually dominated in, not actually most, bonds in Kenya are dominated in Kenya shillings. So if you have dollars or euros and want to invest in bonds, then you have to expose yourself to foreign currency risk. And when you want to say the bond has matured or you're earning your coupon, then you always will be exposed to foreign currency risk. So then real estate offers an alternative to both, even though the return may not be as high as for equities and for bonds here.
Okay. Just I want to piggyback on something. I haven't heard either of you, and maybe you did say it and I didn't miss it, touch on just the importance of diversification of a portfolio. Do you have any thoughts on that? I mean, so for example, as opposed to me having 10, money market funds or 10, you know what I mean? Yeah.
Yeah, I would still go back to the volatility aspect, which then means investors will want to diversify their assets or their investments. Because if you invested in stocks today and in the next 2-3 months, the stock is down and you're in a negative position, you do not want to get out at that point. You want to be able to remain and wait until you're able to make money. And so real estate offers a safe, I would call it safe, a predictable way of diversifying your investments. If you're in bonds, there's a certain limit to which you would want exposure to government bonds, especially right now when there's so much uncertainty on local borrowing and the capability of government to repay you. So you want to diversify your risk because, say like the case for Ghana, people had invested in government bonds, and it got to a point when government could not repay its debt, everybody had to take a cut or a haircut. So it on the investments in government. So if you had $1 million, government says it's 30% cut. So that means you lose 30% automatically for everybody in the country. And that is why real estate offers a safe and predictable avenue for you to diversify your risk.
Yeah.
Here's the thing. We follow the markets and we follow the markets closely. I was just basically making a case for real estate. I do understand that any investor would want to de-risk as much as possible. But again, what does the market say? One thing you're going to notice is, for example, this whole week, there was an undersubscription when it came to treasury bills as well. So that tells you something about the economy. It tells you that people want to hold on to their money a little bit more. The SACCO regulatory authority gave out a report, and you would have actually noticed, for any one of us who actually went through that report, is the number of savings went up. And I think that's why we're also here to talk about real estate. Yes, because now that provides an alternative. It's an avenue for someone to, diversify as much as it possibly can.
Right. Okay. I hear you. Thanks for that. And I want to talk about, and I like how you talked about the market right now, right? And this, again, based on the 3 different fields that you're in, as a legal practitioner with different developers and potential owners and leasers, is there a boom, a boom right now, a short-term rental boom right now in Nairobi? And what's driving the boom? I mean, I think everywhere you look, there's a new, apartment going up, especially if you're in, Kilimani, Kileleshwa, near Junction. So is there a boom right now? And what's driving the boom? Let's start with you, Nelly. Yeah. I guess even given your context as a lawyer and this work that you're doing in the real estate space. Yeah.
Actually, in my experience, for the last between 3 to 5 years, there's been a serious boom in this space of off-plan. People are buying off-plan apartments a lot. I think it's because of the factors that you said about real estate, why people are now preferring to do, you already have bonds, you already have equities, now you are looking for a way to diversify your investment. One of the ways that you can diversify your investment is buying apartments. And I think there's also a serious move from, initially we used to buy plots in Kangundo, plots in Kamulu, everywhere. But now people have realized that there's for you to be able to get income out of the real estate, as opposed to just speculation, you can actually be able to invest in an apartment and get rental income out of it. So there's a lot of purchases, there's a lot of interest in off-plan purchases, and also because of how it is, many developers are structuring it, allowing you to pay over a period of time during the construction period. I think that is one of the factors that is encouraging that. Also, there's a lot of movement. I think a lot of movement from rural areas to the cities, to Nairobi and to other urban areas. So we've seen that a lot.
Okay. Do you guys have different perspectives?
No, not really. Here's the thing. If you were to look at the fundamentals, yes, there is a case, supporting that hypothesis, actually, that there is a real estate boom. So look at it this way. In 2019, according to the last census, our population stood about 48 million. All right. So currently we are at about 53. The government is expecting that by 2029 will be about 57 million. All right. So again, you notice that there is population increase. All right. Now, if we're to just look at Nairobi as a market in itself, 1 out of 10 Nairobians own a home. Okay.
Mm-hmm. 1 out of 10.
1 out of 10. Across the country, relative to the population, there are only about 13 million homeowners.
13 million.
13 million homeowners. So that tells you that there is a huge potential in the real estate space. Believe you me when I say this, Vaal is one of the biggest developers in the country. But if you were to look at the opportunities in this space, the only thing we are demonstrating is just potential.
I wanted to add on to what they have said on the boom on short-term rentals. And it's because looking at Nairobi as a city, first, Nairobi is a gate to the investment hub in East Africa. So if an investor is coming to East Africa and they want to invest, the number one consideration would definitely be Nairobi. And so there's a lot of interest here from a regional business, people coming in as consultants. We have multinationals, UN. So there's a big space for international guests. And that is why then we see, if you look at statistics on listings, on short-term stays, they have been going up year on year, meaning that people consider Nairobi to be one of the places they would like to stay if you're considering short-term stays to be 0 days to maybe 6 months. Since COVID, there has been work from home. So there are digital nomads who work for international companies and can live anywhere in the world. We'll always consider Nairobi, given the climate, the good working environment, safe spaces to stay, and the leisure that is just generally offered if you're in Kenya as a visitor. So I think that too has contributed to that.
Samuel, a question for you, I guess, as a person who's working with Vaal and essentially in this business. Who is the primary target for the short-term rentals? Who's the market for this product?
So again, based on what she said, you'll notice that we've had a very stable political and economic environment. All right. There are a lot of greenfield investments coming into the country, a lot of foreign direct investments. You have a lot of expatriates coming into the country, business travelers as well. We are doing Talanta, so that also creates an immense opportunity for us guys in the real estate space, and especially those like ourselves whose primary target is actually investors. All right, so that forms the bulk of the clientele that you're mostly looking at. So business travelers. Of course, there's also tourism. I think for the last 2 years, we've actually experienced a boom in that sector as well. All right, so business travelers, tourists, expatriates, and especially in the blue zones area, in the blue zone areas. So you're looking at Westlands and Riverside as well. And I think that's where you're seeing developments such as this, Divine. Yeah.
Okay. I have a question for both you and Linda with regard to the shortage, because you've talked about all these people who potentially are coming in, and I want to actually give some stats on that, because I think Nairobi right now, typically, I think they're saying has a population of about 5.7 million and is projected to get to about 7 million by 2030, right? In addition to that, with regard to the tourists, this year we had 2.3 million tourists coming into Kenya, of which 27% came for conferences. That's about 640,000, and 44% came on holiday. That's about a million, just over a million people. And they're projecting again by 2028 that our tourist numbers will be at 4.4 million. So if I'm looking at the primary target for short-term rentals as potential people who are traveling for work, digital nomads, potential just people who are tourists, I'm now curious, what's the shortage that's there right now that would give me a case for, you know what, I should put money into this because in the next 3 to 4 years, we need to fill this gap?
There is a shortage when it comes to premium apartments, most definitely. Here's the thing, developers build, and the funny thing is, very many developers who are chasing after the same demand. You are dealing with people who are coming from Europe, Southeast Asia, North America, all right? So there's a certain level of standards that you're used to. For example, being in an establishment that would ensure that, they have facilities, the necessary facilities for them to take care of the physical health, all right? If you're to look at one of the developments that we've actually done called Wilma Towers, I think we were the pioneers in the real estate sector to actually do a jogging track within our development with actually synthetic rubber, okay? We are coming up with a development right behind Junction called Symphony, and we intend to do a jogging track right at the rooftop as well, okay? Yes, all right? So it's going over and beyond just offering satisfactory services. So you want to take care of their needs as a whole. So that's what's mostly lacking. So such spaces.
So if I've gotten you in summary, it's basically that there may be a good number of premium apartments. However, there's not a good number of differentiated apartments that are really giving value to a potential traveler, a potential person who's coming from a more developed market with a certain level of standard that they are used to. So, yeah.
You're exactly right. I mean, if you're to look at guys who are especially coming from North America, you're going to realize if they come from cities like New York, they're used to having concierge services in their apartments, all right? It's not something that is typical of the Kenyan developer to offer that. And those are some of the things that we've actually noticed. And those are some of the things that we are very mindful of ensuring that we actually give to the client. So it's going over and beyond, all right, what is just standard. Yeah.
All right. Nelly, I'd like to come to you and I'd like to look at the regulations that are required, right? So I think maybe it was a couple of years ago, last year, there was a number of incidents with Airbnb properties, right? Essentially, that's really looking at short-term rentals. They fit into short-term rentals. And so there was some legislation or some policy that was passed, and now Airbnbs are regulated under the Tourism Regulatory Authority. And to be able to have one, you need to obtain a license, you need to obtain a single business permit, you need to comply with NEMA rules within the specific jurisdiction that you are in as well. And then there's the tax stuff that comes in, where there's a 16% VAT, digital service tax, etc. For a person who may be considering short-term rentals, is the legislation geared specifically for Airbnbs, or even if I'm just doing short-term rentals, I need to be registered under the Tourism Regulatory Authority?
The challenge we have currently with our legal system, we don't have one statute where we can say that regulates short-term rentals. So we are trying to apply different statutes to just try and cover that space. I think it has developed faster than our regulatory framework has developed. So we don't have any particular law that we can refer to and say this specifically regulates the short-term rentals of Airbnb or Booking.com, whatever short-term occupancies that are there. We don't have that. However, there are different pieces of legislation. Like when it comes to tax, now we look at the Income Tax Act. What does it provide on taxes that are payable for someone who is offering that service? Which comes now to licensing. It is licensed under the tourism board, is the one that gives you a license for that. So we have to keep looking at different. So it is a law that is still being implemented. The rate of implementation is very slow because compliance also is very slow. We don't have one single instrument that regulates that. So everybody who operates as short-term rental is supposed to procure a license. You're supposed to register under the Tourism Regulatory Board and then get a license. However, that license does not distinguish whether it is you as a person who's just rented this to offer short-term rentals, or if I offer Airbnb in my house, am I also under that regulation? Or if I'm offering it as part of as part of hotel apartments, am I still subject to that regulation. So there's still a lot of loopholes and we don't have a lot of clarity on that. So the implementation has not been very strong on that, and even the people don't have clarity on what applies.
Yeah.
Yeah.
Okay. Because actually the next question is going to be, and sorry, so I'm really coming back to you because like this is where you sit. So if I buy a property here, do I need to register, or is the property as a whole registered under the Act, and therefore I as a specific owner don't need to register?
I hope you do buy, actually. So again, it depends, because we've curated our offerings in a very unique way. All right. For example, Divine. So this is actually hotel apartments. So where we are, and it's gonna run as a hotel. So Vaal is only coming in as a developer. So you have got two other partners. You have City Blue, who is the brand partner, so basically the franchisor, and then you have Vala Hospitality, who is gonna manage it. All right. So Vala, they have the experience. So I mean, we have gone around the regulations a bit to ensure that guys who are looking for investment units don't necessarily have to think about the regulatory bit. Not that I hold any against Nelly. It's just, again, it goes just back to curating unique products. But again, you also have developments that we have done where guys, want to manage their own units. So for that, they definitely have to follow the legal framework that exists. We have very little control over that. But I think moving forward, for us as a company, is we want to ensure that we get headache out of our clients when it comes to regulations and management, and just basically that.
So it would be safe to assume that, once the regulatory framework catches up with where we are, you guys would take that burden off of the potential buyers, depending on how they've bought the property and whether they're allowing you to manage it or whether they want to manage it on their own.
Yeah and no. So again, it depends, because you see, the thing about policies is that, and especially in this country, it keeps on changing, and they keep on changing with regimes as well. We have very little control over that. We would wish for a clear policy guideline when it comes to these matters. Sadly, at the moment, there are very many loopholes and gray areas. And that sort of negatively affects the market. And that shouldn't be the case, really. So we are hoping that, the necessary people who actually the lawmakers would actually sit down and come up with a proper policy framework that would guide the industry.
Yeah. Okay. Nelly, I want to come back to you around the regulation or lack thereof. I mean, at the moment, we have a regime that is, very interested in housing in one way or another. And this was from a Knight Frank report. I think it was published earlier this year. And basically, they were talking about the potential housing crisis. And because of short-term rentals, especially, I think the case study they were looking at was in Nakuru. And rent has gone up for regular housing by 10% because of short-term rentals. Because basically, people who have owned houses have now converted to short-term rentals, and it's giving them more money. And so what's that done for the other landlords if they've increased their rent by 10%? So Knight Frank was, in the Knight Frank report, essentially they were warning about that there needs to be some legislation and there needs to be some policy to come in to avoid a housing crisis. And because the current regime is driven with trying to provide housing, do you foresee some policy potentially kicking in or coming into place that may potentially affect an investor who's in the short-term rental space?
I think ultimately, yes, there's need to come up with a proper legal and legislation framework. And I think that is going to happen sooner than later, because you see what happens is that, unfortunately, in our system, the law is one that is always catching up with us. Instead of us catching up with the law, we always precede the law. So that's what is going to happen. But also to comment on what he has said, I think also it depends on how a developer structures the product. If you structure a product in such a way that you have a single operator or a single property manager, the property manager is the one who registers the entire property under the tourism regulatory board and everything, so that the license that is issued for everybody who is part of that development. So individuals don't have to go individually seeking for their own licenses or even having to think about their own taxes, because it is managed centrally.
Yeah.
So I think, yes, the answer to your question is yes, it's sooner or later we are going to have that. It's going to happen. So what will happen is that now developers will have, and property owners will have now to start thinking outside the box on how well to structure their products and how to structure their tenancies to ensure that they have accommodated, there's enough leverage. Yeah.
All right. I guess at this particular point, I'd like us to get into the return on investment case specifically for short-term apartments, and specifically this one. So I guess for those who might be in the audience, if there's a space for you to get your notebooks or calculators to actually do the math, like this would be the space. So for starters, if you could just give us the description of why this property is unique and what makes it stand out from other regular short-term rentals.
Good. So again, it goes back to curating a product that investors are going to actually find worthwhile. One of the things that you're going to realize is that we are in a blue zone area. All right. So there are very many embassies around. So you have the Ugandan embassy, the German, Philippine, Japanese, all situated in this area. All right. So that creates a demand. So it tells you that there is a market for it. But again, we are not the only developers in this area. So we had to think of, how do we leverage on, our expertise to create something that would be of great benefit to guys who are considering investing in this area. So what's unique about Divine is the fact that you are literally considering a hotel apartment, okay? And it alleviates the need for you to manage it, to market it, okay? Because our other partners are going to do it for you. So there's going to be a revenue sharing ratio between the owners and the hotelier, all right? So which is 56.5% going to the owners, 43.5% going to the hotelier. Now the hotelier basically covers all of the liabilities. Insurance, personal insurance, lift insurance. They also take care of the property, okay? They also do the marketing as well, the management, they hire the staff. And then now the income is also pooled. So what that guarantees investors is whether you've had an occupant in your apartment or not, all right, every quarter you are entitled to a revenue share, which is proportionate to the size of the unit. So the bigger the plinth area you acquire, the more money you actually get. So that's what is unique about it. Now, we have done our studies, and based on the rates in the market, what we can guarantee investors is that they're looking at anywhere between 20 to 25 US dollars, all right, like returns per square meter, all right. So that's what we can guarantee. So that's why we actually chose to do Divine.
Yeah. What are the sizes of the 1 bed and the 2 bed vis-a-vis the $25 to understand what the guarantee is?
Good. So the smallest unit that we have here is roughly about 60 square meters. And then they go all the way up to 150 square meters. All right. So we have two different types of 1-bedroom units, and we also have two different types of 2-bedroom units. And then over and beyond that, the good thing about it is the fact that, investors can also utilize the property. It doesn't mean that just because it's going to run as a hotel that you can't utilize the property. You can. You'll still pay, which is good, because it's still money that's going to come back to you at the end of the quarter, no? But the most important thing about Divine is that it is an investment platform for our clients. So we're mostly focused on ensuring that our clients get the best yield the markets could give.
Yeah.
Yeah.
Okay. So this I just did the math on the 60 square foot apartment, and that would be $1,500. That's over the quarter. That's paid out quarterly.
So the $20 to $25 per square meter is actually monthly.
Monthly.
That is monthly.
That's monthly.
So
okay.
You're looking at anywhere between 60 to 75, all right, per square meter. Yes.
Okay. Finally, what are the ownership and the legal requirements regard to owning and I guess an apartment in a space like this? What are the things I need to get through? Is it still the regular conveyancing framework that I'm going through, or is it slightly different?
It is the same because ownership of property and land in Kenya is just governed by the same statutes. That is the Land Act, the Land Registration Act. Those are the main statutes that govern that. So it will still be governed by the same statutes in terms of the process. That is both the process of acquisition and the process of registration, and also in terms of the title documents that you get at the end of the process. It's still the same title that you'd get if you're buying a regular apartment. So the process of buying this would be similar to the one that you're buying an apartment. That means you have to go through the process of getting a sale agreement, and by the time you're getting a sale agreement, you need to get a lawyer to do for you due diligence. So ensure that you've done your proper due diligence. If you're a buyer, ensure that you've looked at the title documents for the land, the mother title. Ensure that you've looked at all the approvals. Has the developer obtained all the necessary approvals, zoning and construction approvals? Have all of them been obtained? And is there compliance? Most of the approvals come with conditions. Have all those conditions been complied to and complied with? And then you also look at the sale agreement. What is in the sale agreement and what protects you as a buyer? Is there a specific payment plan? And have you negotiated a payment plan that ensures that you're comfortable with it and it's spread out through the entire construction period? I know if you pay earlier, you get certain discounts. There are incentives that come when you pay earlier, but then you're also allowed to pay longer. It might be a higher price, but you are given the convenience of paying longer as long as you pay before the completion date. And then also once you have a solid sale agreement, then there's the process of title, ensuring that you get. So the title that governs, the system that governs this kind of development is we're calling it Section of Properties under Section of Properties Act. So each person will get their own title for each of the apartment. It is a direct title between you and the government. There's no in-between person. And then now once you have your own title, then you get into there's a hotel management agreement, which you sign up to now with the hotelier. So now there's a contract between you and the hotelier, which now stipulates, and it's a standard contract across everybody. It stipulates the terms of the operation, the terms of management, how much do you get out of this contract, and for what duration. So all those now are contained in that. But in terms of title ownership, the same process.
Sorry, if you also don't mind me saying this, but and especially for clients in the diaspora, because what they're constantly looking at is, okay, I'm buying an apartment in a different country, I'm buying it in dollars. How do I hedge myself from the volatility of the currency? So you have unique products like this in blue zone areas that actually allow you to get a return on your investment in USD.
That's interesting. Linda, I want to ask you a couple of questions around Nairobi's positioning against other potential cities, whether it's Lagos, whether it's Accra, Johannesburg, Cape Town. What's based on, I guess, your analysis and what you see, what makes Nairobi premium, because I guess we do talk about Nairobi as a Silicon Savannah, so people talk about, but not necessarily as a hub for real estate. What's your take on that?
Okay. So first of all, Nairobi, as you've said, is marketed as the Silicon Savannah for Africa. But then rarely will we hear Nairobi marketed as a premium real estate investment city, or marketing of investment opportunities in Nairobi. And so if you consider Nairobi from a return perspective, we've said returns are between higher single digits to lower double digits, so between 7 to 12%. If you go to Lagos, return might be higher, but then you'll have to pay a higher price for the same unit, or for the same rental unit, or for the same property. And also looking at the macro environment around Lagos or Nigeria in general, the inflation is worse than Kenya's. Their currency fluctuation is also very erratic compared to Kenya. And so then, despite the fact that you would earn a higher rental yield there, it means in Nairobi, your investment is a bit safe. Yeah, it's a bit safe and stable. If you look at Accra, in terms of vibrancy, the city is less vibrant than Nairobi. They receive less visitors. Less multinationals are headquartered there compared to Nairobi. So if you go to Joburg, I mean, the economy is way bigger, but then the yield is less than Nairobi's, because it's between, I think, 3 to around 7% max. So that means it's a bigger city, yes, there are more visitors, higher population, but then you get a lower yield. And so that then now markets Nairobi as a premium destination hub for real estate investment. Yeah.
And what are the things that need to remain constant? That, we've talked about the projected tourism numbers going up, we've talked about the potential population numbers going out. But what are the things that need to remain constant in an economic environment that would ensure that these returns that we are projecting now would continue to be for someone who's invested in a short-term rental?
First, I'll answer that question in 3 dimensions. So from a demand versus supply perspective, if you're looking at demand, then it means Nairobi needs to, or Kenya needs to remain as a top hub for business, for corporate guests. We need to keep hosting the multinationals that we are hosting and the conferences, and Kenya needs to still remain as a top tourism destination in Africa, so that we keep getting the demand that we are seeing. If you're looking at locals, then income needs to keep on rising, so that we have more middle class that are able to afford such units. Looking at the supply perspective, what he mentioned, developers need to continue curating, premium properties that offer more than just basics. Amenities need to be in check. The security, the property management needs to be in order. From a macro perspective, and this now falls onto government, the infrastructure needs to keep on improving. Right now, we have the expressway that gives access to if you're coming from one side of Nairobi to the other, it's easy to access using the expressway if you want to access the airport. So infrastructure, amenities like water, electricity, needs to keep on improving. And then the inflation and currency, that also needs to keep having some balance, so that it's not erratic, because once it's erratic, if people can't predict inflation tomorrow or where the currency will be like we had last year, then they get a bit jittery about investing. Yeah.
I mean, right now with where we are, would it be something that someone should keep in mind, given, so we've been relatively stable, yes. However, there have been protests, there have been issues. There's people are demanding for better leadership. We don't know where that will come at, or that will be the case. There's been issues around the finance bills over the last 2 years. So should that be something at the back of my mind where I'm like, okay, yes, we're stable-ish, but sometimes it almost feels like, things could potentially tilt. And of course, political leaders keep saying, oh, if you keep, protesting, or you keep doing this, investors will flee, so to speak?
I'd say yes, definitely. When you're investing, the macroeconomic environment will always get to you, whether you are aware of it or not. But real estate has some sort of, I would say, if something happens, I think real estate will feel the effect almost last. Because if you look at when we are voting, and this is not just in Kenya, it's everywhere in the world. If you look at when Trump says we're introducing some restrictions on trading levies on trade, stock markets it goes crazy in hours. So if you invested in stocks, definitely something changes. If you look at when COVID was announced and the world was closing down, stocks were the first to be affected. With governments and investing in governments, of course there's safety always, but so is also the risk, because then you're always politically exposed. But I think generally we are always politically exposed, whether we have put in money in government or not. So if something was to happen drastically, I think real estate as an asset class will always be like the last to feel it here. Yeah.
Okay, fair enough. And just on that, I want to ask, could you please describe for us what an economic bubble is, and then demystify for us whether we are in a real estate bubble? Because there, we've talked about everything going up, properties left, right, and center. Yeah.
Okay, so what happens in an economic bubble? The thing about bubbles, it will burst at some point. Yeah. So I do agree that in Kenya, people will say, oh, there's a real estate bubble. It's not realistic. But then if you look at the fundamentals, which I will explain, I don't really think we're in a real estate bubble. So first of all, in an economic bubble, there's a price increase, sharp rises in prices of commodities, whether it's that is in assets. So if we were in a real estate bubble, we would see sharp rise in price of land or apartment units. Second, there's a lot of speculation in an economic bubble where people expect to make unrealistic and, let me just call them unrealistic returns overnight. So you buy this unit and then you're like, in the next 1 year, I'm going to make double this amount of money. Yeah. And I don't think that is the case for real estate in Kenya, because it's mostly real estate is usually a long-term play. Third, in an economic bubble, there's so much access to credit. So the reason that price rises is because of demand, because everyone has money to buy everything. And we'll agree that accessing credit in Kenya is a problem. The mortgage penetration rate is below 3%, meaning it's very hard to walk into a bank today and get a mortgage, or even just get a loan to buy an asset. And so considering those factors, then I would say we are not in a real estate bubble. The additional and last point is, if you look at Nairobi, there's actually a deficit of housing units, and that is why government is big on constructing units under affordable housing to meet that deficit for the low-income earners and those in informal settlements, or what you would call slums. So short-term rentals or such units are just a small niche of real estate as an ecosystem. And so then you would not say we're in a real estate bubble if on itself government is saying there's a shortage of 2 million units for income dwellers or for low-income dwellers in Nairobi. Yeah.
Okay. So no real estate bubble.
No real estate bubble.
Okay.
Yeah.
Right. Yeah.
The fundamentals also don't support us being in a real estate bubble kind. Here's the thing. We have, I think, about 26,000 mortgages in Kenya worth about 250 billion. Again, fundamentals do support that. So it takes me back to having a stable political and economic environment. You have a steady GDP growth rate. There's political goodwill as well. All right. You have smart cities coming up, such as Tatu City and Konza. All right. You're seeing a lot of greenfield investments. Yes, there is much more to be done, all right? But the fundamentals, from where I sit, are actually, very supportive of people who are looking at investing in real estate at the moment. So no, we're not in a bubble. Yes.
So from what you're saying is all these apartments that we are seeing going up, that is investor confidence, essentially.
It is investor confidence, yes. Again, and it is purely backed by fundamentals.
Maybe actually, if you give me a bit of clarity, because you give a number of technical words when describing the GDP, and so for us laymen, what would be happening for it to say, for us to say, okay, this is a bubble, so that even where I'm seated now, I can be able to look in the future and say, if there's a bubble coming, I can see it and get out before,
The magic bullet is what she literally said. It's access to credit, all right? And not just access to credit, but cheap credit. So if we're to look at, the real estate bubble in the US in 2008, guys were literally getting money for free from the banks. Okay. So what happened is, guys would take a charge on their property, and then they'd go back to the bank because, again, it's cheap money, and take another one and another one, all right? So that drove up inflation. The government had to raise the interest rates. And then now you're going back to the government, and you're going back to the bank, and if you were to pay maybe 2, 3, 4% on your mortgage, now it's almost triple. Yes, so that is the magic bullet.
So free credit. And just demystify that for me against the message that I may get from my bank, because nowadays there's a messages about, you can get an unsecured loan for X amount. So what's the difference between that and the free credit we're talking about, or cheap credit?
It wasn't free.
Yeah,
it was
cheap. Yes, cheap.
All right.
Cheap credit.
Yes. Again, you still can't get an unsecured loan, but it still doesn't come cheap in Kenya, and that's where you're going to realize that when it comes to credit, there's no deep penetration in the market, all right? To some extent, I'm really hoping that, this is something that the government can actually work on. Recently, you had the president talk about it, that it is, in his plan to ensure that in the next 2 years, people can actually borrow at single digits. Again, I don't know how that's gonna be achieved. If it does happen, that would be well and good. But again, it also brings about another aspect. Okay, if you're to look at economies, let's say for example Joburg, which have very many people in their economy who actually own homes, it is because they have had access to cheap credit. All right. So again, it's usually a balancing act when it comes to the economy. Too much of everything is poisonous. Cheap loan, very, very poisonous. But sometimes you also need that to drive the economy. So again, that's gonna fall back to guys at the Ministry of Finance to figure out that balancing act.
Okay.
Yeah.
Allow me to digress a little bit, Linda, and ask you this question around just what you're talking about in terms of our banks not allowing us to borrow at single digit. What's the driver for their expensive loans or expensive credit?
Okay. First of all, we blame the government. Yeah. And this is because if you look at the government borrowing is, they're very aggressive on local borrowing and offering, I would say, good returns, risk-free borrowing at good returns. Because unlike this year where, say, rates have at least come down a bit, last year you could get 18% on a risk-free investment. I mean, why would you not take that? And if you would look at treasury bonds and treasury bills, the big buyers were the banks. So then as Linda, why would the bank lend to me at, say, 20%, Linda, who they are not sure will pay, yet they can lend to government at a comfortable 18%, and government will pay. So first of all, government is to blame. Second, it's the risk profile generally, because when we'll admit that the ease of doing business in Kenya has not been good here. There has been a lot of challenges, and so most people cannot pay their loans. That means the default rate has gone up, and so banks are now more cautious on our ability of businesses, that is SMEs and individuals, to repay their loans. And so because of that, then they have to price their risk higher, meaning we get to pay higher for our loans. For this year, CBK has, yes, come and said, yeah, we have reduced the rate at which we lend to banks. So we expect banks to lend to you at cheaper rates. Unfortunately, because still government is borrowing and giving good interest, banks do not have a case for giving individuals and businesses money cheaply or giving them a lot of money when they can lend that money to government. So if you look at CBK statistics, yes, the CBK rate is down, but if I still walk into a bank, I still get the higher, the 22s, the 20s, the 18 if it's cheap rate for a loan. So I'd say it's more false on the fiscal, that is the government implementation, on especially now that rates have come down according to them. So they need to sit down with the banks and tell them you have to comply. So banks right now are still not compliant. Yeah.
Barak, you notice that for the last 2 years, it's been tough on households, all right? And that has a ripple effect across the economy, okay? Because the moment you reduce the a populace purchasing power, what that does in return is it reduces the appetite for credit, okay? And then what she's saying, banks are borrowing, and they're borrowing heavily in the local market. So the biggest issue that we're having currently is, I think government is now slowly coming to terms with that. And that's why you're seeing policies such as Kesonia coming up. And it's a bitter pill for the banks. Do I support it? Yes, because it is industry best practice. What you are probably gonna see in the near future is banks are gonna lower the rates just a little bit, all right? But it is still not enough to cover the non-performing loans that actually exist at about 15 to 18%. That is a challenge. Yes.
Okay. So I mean, essentially, if I've understood all you guys correctly, is the market that we are in still largely a lot of people still won't be able to afford houses, and therefore short-term rentals or rental properties are still going to be have a really good case for ROI, purely because people still cannot afford to buy houses because the credit facilities won't allow them to do so. Would that be a fair assumption to make?
Well, you're partly right. And then it goes back to the statistics that I gave earlier, that you have 1 out of 10 Nairobians who own a home. So what's that now? I mean, it is an existing problem. It's a bad thing for any country, but you see it creates, in every problem, there's always an opportunity, all right? So investors are actually seeing an opportunity. Yes.
Okay, so my next question is going to be based on even the little monopoly game that we had earlier, where I think it was maybe 50-50, if not in favor of the cheaper properties, where people, even in this crowd, were more willing to go with a cheaper property that may have more frequency as opposed to a more expensive property with less frequency. So what are the occupancy expectations for a luxury apartment?
I think 70% on the bare minimum is good, all right? I'm so sure many of the people seated here and who would be listening to us, they'd be wondering, but is there a market? Yes, there is a market. And it goes back to what we have been discussing, that, as much as, the government has a lot to do, at least they have shown goodwill when it comes to foreign direct investments, like bringing investors into the country. They could do better, all right? You have, which I'd say is luck, just by luck that UN considered to bring, 3 of the departments here. That's gonna open up the market as well. So 70% is good. Is it doable? Yes. And I'm also talking from experience because in one of our developments called Elite, just right off Westlands Road, they're looking at about 90% occupancy rate a year. So the market is there. Yeah. And developers, we generally tend to follow what the market gives. All right. So it's a market that determines the price. It's a market that determines what type of units you ought to do.
Yeah. Okay. Nelly, I want to talk to you a little bit about co-ownership structures, because and in this essentially I'm looking at trying to look at this myth that real estate is only for the very wealthy. And I want you to maybe give me a bit of context on the different legal structures that are available for co-ownership of real estate in this country.
Co-ownership means buying together?
Multiple owners basically.
Okay.
Yeah.
We have a system of co-ownership. So you can either own a unit as joint owners. So if you are your spouse's husband and wife, you can jointly invest together and own the unit, have the unit registered in your name. And then there's another system called tenants in common. Tenants in common, you don't have to be related, you don't have to be husband and wife, you can just be friends and come together and invest in a unit. And then you agree on the level of and the proportion of how much contribution you're going to make. And also the title for co-ownership actually records the share. So if I give 30% and you give 70%, it will say, I own 3/10, you own 7/10, and it's recorded on the title. That's called tenants in common. And then you could also invest through a company where you form a limited liability company, whichever number, you are 2 of you, you are 3 of you, and then you own the unit using the company. So in the company you have shares depending on how much you've contributed towards the purchase price and towards the acquisition cost. So you can be registered as a company and then you own, so the income comes to you as a company and then you distribute to the different shareholders. So that our legal system allows you to do that.
It's kind of
yeah.
And maybe just to, this is again off the cuff, but just to demystify or look at the difference between this and real estate investment trust. Are you able to give a bit of a distinction between the options you've given in a real estate and investing in a REIT?
So investing in a REIT is a bit more structured. So REITs operates like collective investment schemes, where a scheme comes up with they fundraise, they come up with a fund and say, this is fund we are going to invest in a particular property. So it can either be a development rate or it can be an investment rate. Development rate is where they develop the property. So development rates, you develop, they come up and they buy this property and then they say we're going to develop and then we are going to sell. And then whatever income that is going to come from there, we are going to distribute to our different investors. So you invest the same way you invest in a unit trust. So they have a minimum amount of money that you would say that you invest this amount of money and then you get a return based on your investment. So for the other investment rates is where they come and maybe they say, we're going to rent this space. And then out of the rental income, we're going to distribute that to our investors. So yours is through that trust. So if you are to compare that now with this one of owning, so this one it will be the direct ownership. REITs, you don't have a direct ownership towards the property. The property is either owned or rented by the fund itself. But this one you are owning directly as yourself. So if I'm getting a tenant, I'm getting a tenant as Nelly. If I'm getting an income, I'm getting an income very directly. So I know if we have money, we have money. If we don't have money, we don't have money. But this other one it's pulled together and then you just get out of the income and out of the return of the fund itself.
For the other options, like with the tenancy in common and the others, is there a limit to the number of people? So for example, if I say all of us want to invest in this thing, can 20 of us pull together and buy an apartment? Is there a limit on that number?
So there's no limit. There's no legal limit as to the number of people who can be registered on the title. But what it does is that it looks very untidy. You see the way our titles are, it's like a very standard title document, 1 page. So if you put like 20 people and the ownership section, they'll either have to minimize the font. I don't know how they're going to do it. So what we advise people, if you're a number of you, we always advise you to just come up with a company or an entity where now you register the entity and then now you own it indirectly through ownership of shares. But there's no legal limit as to how many people can own a property or a unit.
Okay.
Yeah.
And I just want to give some context just for the final question that I have for us and for Nelly to answer, just to give context based on, I guess, what Val provided for me in preparing for this interview. If we're looking at properties that are around here, you potentially could get a 2-bed apartment here for what you would pay at Radisson Blu, right?
That's essentially correct. And that's why at the beginning I mentioned that we don't just do developments. There's usually a lot of like extended research that goes into our decision-making process. We've looked at the market extensively. We have gone to these places. We've seen what it is they're offering. We have figured out what it is that is lacking in the market and how we could come in. So you're not far off.
Yeah.
Yes. So the numbers are actually right. Yeah.
Awesome. Thanks. The last question, Nelly, for you is on this. We've seen that, because this essentially is disruption in one way or another, and we've seen that disruption upsets the incumbents, right? We've seen it with Uber or other innovative ways of doing business where they've come in and the people who are there aren't happy about it. So I'm wondering, legally, do you foresee potentially a space where short-term rentals become such a big part in the market, big play in the market, that hoteliers then now, upset the market, so to speak, and try and pressure policy or, something to try and drive some sort of control for this? We've seen in specific markets, I think Bolt, if I'm not wrong, Bolt exited a market because the government that they were in was pressuring them to have a specific price point for their rides and things like that. So I'm just wondering whether you foresee legally and with policy the potential of hoteliers getting to a point where short-term rentals have taken so much of their market that they try and find a way to curb and control that via policy.
That is a possibility. It could happen, but then you also look at other markets, because these short-term rentals are not only in Kenya, they're also in other markets as well, and they've also destabilized the operations in other markets as well. So yes, we say there's need for policy, there's need for regulation, but where I see the place of regulation will be just to control how you are doing it, not to come and control the pricing and to come and say that because you're pricing this lower, you need to raise it higher or you need to do this. I think pricing is mostly determined by the market and not by the law. The law will not be able to come in and say that this is how you should price the short-term rental, this is how you should price the price per night, or this is how you should price this. I think that is an unlikely event, but the likelihood of coming up with a policy to control how short-term rentals are managed and how to even getting a contract, like how do you even contract for a short-term rental? Don't have a legal system for that. That we need to have that so that we can standardize. For protecting the consumers, we may need to standardize that, but I don't think the pricing will be controlled by the government.
I'm curious on that thread because, we do know a lot of people in leadership and in government own hotels or invest in hotels, right? And we've seen parliamentarians, attempting all sorts of bills and all sorts of things. I don't know if it would be too far of a stretch to assume a parliamentarian would come and try and have like a huge tax levy on short-term rentals to ensure that their hotels don't get too affected.
I think, as she said, in Kenya, the law catches up with what is happening with us rather than the reverse. And so if you look at lately, the policies that have been put in, especially around innovation, the government has been more reactive rather than, that's why we saw them try to introduce a digital tax on creatives, which brought a lot of issues and controversy. So I think if there was to be policy, number one, government will always focus on revenue collection. So they might introduce like a bed tax to match what hotels pay, or something, just to make this space almost equivalent to having a hotel. And so I think the first reaction would be on revenue. So, and what she said, like ensuring there's a system, so they're able to collect data and to ensure nobody's evading those levies or those taxes. Yeah.
Okay.
Yeah.
Last one. So as a developer, potentially what do you do to curb that? Because it's a potential maybe not, maybe a threat may be a strong word, but potential, risk?
It's a good thing we have Nelly on our side now, no? It's a free market. Let's appreciate that. And we also need to appreciate the fact that, at least we have the 2010 Constitution. So again, it's just, if I was just to emphasize on what she said, it's interest will always be there from the powers that would be. But we try our level best as a developer to maneuver in the spaces that we are in, and we try and ensure that we do so while honoring the laws of the land. Yeah.
Okay, thank you very much. And thank you guys very much for listening and being a fantastic audience. If you do have any other questions, I'm sure, I guess they're not in a hurry to leave. You could ask them immediately we're done. If you'd like to see the show houses, that's still available at your leisure. But thank you so much for coming for this first, I guess, Financial Incorrect and Vaal community event. I hope it has been valuable. Hopefully you've taken away a lesson or two. And we will see you guys at the next one. Thank you.